depositing money like Bitcoin, MasterCard, Visa card, every available Skrill and PayPal, all of those things. And we also have to make sure that the withdrawal process is very fast. Like some of them that I listed there can even deposit your money into your bank as fast as 3 hours. That is SNES. As fast as 3 hours into your bank account. The fourth criteria we look at is trading platform. We have to make sure that the broker that we're using supports the common trading platform, which is MetaTrader 4, MT4, MetaTrader 5, MT5, and CTrader, at least basic. The fifth criteria is execution. You want to make sure you are with a broker that executes super fast, like closing of trades and placing of trades. You have to be very fast. And the last thing is you have to make sure you are working with a broker that the customer service are responsive, they are respectful, and also they got your back. They can solve your problem at any time you go to them. So these are the 6 criteria that we've actually looked at before selecting all these brokers that we have there in our description box. All of these things are what we have considered before selecting all these brokers that we have. So we have IC Market, we have XNET, we have Ugosway, and we have Tradersway. All of those links in the description box. You can use any one of them. Now note, IC Market do not accept residents from United States and Canada. So residents from United States and Canada are advised to use any other ones that are available down there. Forex market hour. We've got 4 types of sessions in the Forex market. Now we have London session, we have New York session, we have Sydney session, and we've got Tokyo session. London session is the busiest and the most highly volatile, followed by the New York, and Sydney and Tokyo come next. So now, for the day, this is calculated in GMT, all right? So the Forex market starts first with Sydney. Sydney opening first on Sunday, 10 p.m. in the evening. So Sydney starts this Forex market. So you can see, then immediately Tokyo joins as at 12 o'clock, all right? So Tokyo joins, and Sydney stops at 6 o'clock in the morning, while Tokyo is still in existence. From here, London opens at 8 a.m. in the morning, because that is when London session, the banks open. Now, if you notice, if you trace this time to Sydney, it's going to be 8 a.m. Sydney time too. It's going to be 8 a.m. While this is also going to be 8 a.m. Tokyo time. So this is 8 a.m. London time in London. While in Eastern time, it's also going to be 8 a.m. because that's when the banks open. As long as the banks in each of these countries are open, Forex market will keep on rolling. That's why it is 24/5 all through the clock. So now, London session is the most busiest. Now, the time where they overlap, where they meet each other is what we call overlap session. Where they meet each other, where they both meet is what we call overlap session. Now, remember I said the biggest and the busiest is London, followed by New York. Now, what happens when the 2 big giants meet at the same time? There's going to be high volume, high volatility in the Forex market. When is the best time to trade? Now, the best time to trade is always within the London and the New York session. Now, the reason why I'm saying all of this is because of volume. You want to trade when the big boys are awake, when the huge banks are awake, to make sure that there's a lot of liquidity, a lot of volume in the Forex market so that you can play fast. Sydney session is always super slow, while Tokyo session is always slow. But when they meet at the same time, it is a lot faster. But whereas when it's the early hour of Sydney, it is always very slow. And the late hour, when the Sydney has also gone to sleep, Tokyo session, which is this session right here, 7 o'clock, markets are always very slow. But however, there is no specific time to trade. You can trade as long as any of these session is open. That is from Sunday in the evening to Friday in the evening. Here is a term that you will never stop hearing in the Forex market: bulls and bear. Because this animal, I'm wondering why they have to use this animal. Maybe it's because of the mode of attack. Whenever a bull wants to attack, it drags with the horn. It drags drag the prey up with the horn, drags with the teeth and the claws down. So with bulls and bear, when we say bull, it simply means bullish, or it is going up. All right. If we mean bear, it simply means the stuff is coming down. It is bearish. So these are terms that you will always hear a lot in this Forex market. Bull means long. If you heard a Forex trader is saying long, it's actually saying buy, or bullish, or bull. So if someone say bear bearish is synonymous to sell, and it's also synonymous to short. So these are the terms that is commonly used in this forex market. Here's a chart representing what we mean by bullish, long, and a buy market. This is a chart of Dow Jones showing that it's been going up, it's going up, it's going up. So in this such case, we are going to say this market is bullish. So this market is a buy market. While a reverse example would be bear market. So whereas bearish, short, sell market, you can see this market is making consecutive lower lows, whereas the previous one is making consecutive higher highs. Bid and ask price. Remember I talked on bid and ask price earlier, talking about when you want to buy and when you want to sell. Now, ask price is always the line at the top, while bid price is the line at the bottom. So this price, you're always going to see it on your forex chart, always moving at the top. Now, if you want to buy, you are quoted at the ask price. If you want to sell, you are quoted at the bid price. So just know the two difference. What is spread? Now, if you notice, I didn't really talk much about what bid and ask price is. That's because I intend to talk more about it right here while I'm talking about spread. Now, spread is the difference between your bid and the ask price. Now, that small space you see between the bid and ask price is what we call spread. Spread is what your broker is going to charge you for placing any particular trade. You notice there's a distance between this purple line and this red line. This difference is what we call spread. Now, this is a chart on Bitcoin USD. Now, remember I said ask price is the one at this top and bid price is the one below. If you are going to sell, you are quoted on this one below, which is the bid price. If you are buying, you are quoted on your ask price, which is the one above. Here is a clearer picture how it's going to be on your MetaTrader for when you're about to execute any trade. See, again, ask line is the one at the top, the bid price is the one below. So the spread is this gap in between them. It is always very, very small. It can be in very small pip. All right, now, if you notice 1.13264 subtracted from 1.313252, the difference, if you do your math, is going to be 12 spread. That is 1 pip, 2 pipettes. Earlier, while I was discussing about spread, I made mention of pips and pipettes. Now, here I'm going to explain what pips and pipettes are. Now, the markets move in pips. Each step is calculated in terms of pips. Just as human being is moving, our movement is calculated in form of steps. Each step we make, so the forex market, each step the forex market make is calculated in form of pip. Now, pip is an acronym, and I want you to write the full meaning of pip in the comment section below. The fourth digit number after the decimal point is what is regarded as a pip. Now, here is a pip. Now, this is the decimal point. We are moving 4 places. 1, 2, 3, 4. So 7 is the pip. While 0 right here is the pipette. For example, I enter into AUD USD trade at 0.72170 and I exited at 0.71432. The simple thing that you are going to do in order for you to know the difference, how much pip I made in this example, is to subtract this 0.72170 subtracted from 0.71432. So the answer is going to be 0.00738. Now, you can divide your answer with 0.0001 since it's the fourth number to your right after the decimal, or you slide to your right 4 times just as we did right here. 1, 2, 3, 4. So 73.8 is our pip. Here is a graphical representation of what I just did. I entered a trade at 0.72170, right? And it kept on coming to the downside. I decided, I thought that, okay, it's enough. I want to take my profit, and I exited at this point. Now, if you calculate the difference between 0.72170 minus 0.71432, it's going to be 73. So that is how much pip I was able to accumulate in this trade. And the exception to that is yen pairs and gold pairs. They are exception. The second digit after the decimal is a pip in yen pairs, in JPY pairs. Now, for example, in GBP JPY, you notice that it is 3 whole numbers before you get to the decimal. Whereas as other cases, you can see it is always 1 whole number before you get to the decimal. For example, GBP USD, we have 1.2949. GBP JPY, you can see there are 3 whole numbers. Whereas all other ones are just the same thing. Anyone that has to do with JPY, USD JPY, you can see there are 3 whole numbers. Euro JPY, there are 3 whole numbers. NZD JPY, there are 2 whole numbers. So in this regard, the pip right here is going to be the second number after the decimal place. After the decimal. What is a piped? Piped are the last or 5th digit in other currency pairs except yen, whereas in yen it is 3rd digit. Now you have to pay no attention to piped. Just as we have in time in wall clock in every home, we have in our analog wall clock, there's a very long one there in the middle and there's a very short one. So this is the hour, this is the minute, and this is the second. So piped can be likened to the second. It moves very fast. So 10 pipettes gives 1 pip. So that is what pipette. So that's what pip is. So we don't really pay attention to pipette. All right. So you just, how many pip did you make today? You just tell them, oh, I make 100 pip, I make 1000 pip, I make 10 pip. All right. So we don't really make mention of pipette most of the time. What is a lot? Lot is simply the measure of volume. Now I talked about pip being the movement. Now, did you know that I could jump in on a trade and I'm going to make $1,000, the same trade at the same time, the same pair, and you also jump on the same trade at the same time, the same pair. We are doing the same thing. We are buying. I'm going to make $1,000. Another person is going to make $100, while the other person is going to make $10. Now, the difference right there is the lots. That is the volume. Now, you would agree with me, someone who is doing business with millions of dollars and someone who is doing business with hundreds of dollars, they are definitely not going to be making the same amount of money in return. And also, they are also not going to be making the same amount. They are not going to be taking the same risk and the same losses. All right, they are different. Now, in what is a lot? Lot is simply the measure of volume. The volume, your buying capacity. That is what lot is. Now we have standard lot size, we have mini lot size, we have micro lot size. Now we are talking about standard lot size when you are buying 100,000 units of the base currency. For example, let's say you are trading Euro USD. You have to be, if you put it on standard lot, that simply means you are buying 100,000 units of base currency. That's a lot, right? So I'm going to be explaining how you can afford to do all of that in the next topic. But first, the lot size, to represent this, you're not going to see one standard. They're not going to write one standard on your MetaTrader 4. It is represented with numbers. Now, when you see on your chart 1.0, that's one standard lot. While mini is 0.1, that's as you can see here. It's represented with these numbers. So if I say 2.0, I'm using 2 standards. Mini start from 0.1, 0.1, 0.2, 0.3, up to 0.9. That's mini lot size. So if it moves up a little and turns to 1.0, then that becomes standard lot size. I believe you get that gist. Why? Micro lot size is 0.01. Very, very, very small. Micro lot size. And 0.01 to 0.09. For example, Euro USD. We are taking this example because Euro USD is the highly most traded pair in the world. Now let's say one lot is equal to 100,000 euro. Remember I said if you are purchasing any currency, if you put one standard lot on any currency, you're actually saying you are buying 100,000 units of the base. So that is why we are saying 100,000 euros. So one lot is equals on Euro USD is equals 100,000 units of Euro USD. So let's say as at this time that we are buying, the ask price was 1.13222. So why make this one small is because this is a pipette. Why this is the pip. Now remember, you have to be relating with all what we have talked about so far. So good. Now to buy one lot, you have to time the 100,000 with this ask price. So you need $113,000. To buy 0.1 lot, which is one mini, you need $11,000. To buy one micro, you need $1,000. That's really, really outrageous. Even for you to buy this one small micro, you still need this amount of money that is huge. Now, for each pip movement on one standard lot, you are going to be making $10 for each pip movement. For each pip movement on micro lots, you are going to be making $1. For each pip movement on on mini lot, this is a mini lot, you're going to be making $1. On a micro lot, you're going to be making 10 cents on micro lot. So this is the difference. So you may want to use this, but also note that once it is going against you in terms of pip, you're also going to be losing $10. If it's going in your favor, you're also going to be making $10. You have to note all of these things. It's about risk and reward. That's how lot size work. Now you will ask, how do I get that amount of money to trade that huge lot? You've noticed for a small micro lot 0.01, you need nothing less than 1,000 USD in order for you to place trade. Now, does it mean if I don't have 1,000 USD, I cannot trade? All right, your broker has got you covered. Now, this will take us to the next topic. This is one of the services that your broker offer you. Now, remember earlier I said broker charges spread and they also charge commission. Now, what would justify that charges? This is one of the services that justify them charging you, which is leverage. Leverage is an amount of money that is being lent to you by your broker to do business. And once that contract or business is over, that trade is over, they are going to pull back their money. Now, you're not going to see it physically on your MetaTrader 4 on your trading app, but this is what they do in the back end. So now, this is how leverage works. Let's say, for example, you've got an account of $1,000 and you chose a leverage of 1 to 100. Now, before I start, you know that in Forex trading, you can have leverage of any amount. Whereas in the United States, the recommended leverage that they require their citizens, always recommend for their citizens is 1 to 50. Now, the more the leverage, the more you are exposing your account. Leverage is a very good thing. Also, it can also hurt you. All right. So it depends on how you want, what you want to do with the account and the purpose why you're opening the account. Maybe you want to risk all the whole money at once. It just depends on you. Now, we have a leverage of 1 to 1, 1 to 10, any amount, to up to 1 to 1,000. Some brokers even offer unlimited. There are some crazy brokers which I'm going to be recommending to you. Now, you can check the link in the description box to see the list of my recommended brokers, the brokers that you should use. Brokers that even allow you to deposit up to a minimum of $10. For example, you are trading an account of these 0.1 lots. All right. So this, which simply means this is one mini lot size, right? So you need $11,000 to trade this market. You need 11,000 of the base currency to trade whatsoever currency. Now let's still use Euro USD as an example, the example that we've been using all the while, right? Now your broker is going to put down 99% of the amount of money that you need in purchasing this particular trade. That is what we call leverage. So 99%, which amount to 11,209 out of 11,322. So your money is just 1%, which you are putting down, which is 113, which is 113, in order for you to participate in this level of one mini lot size. So that is why you can even deposit $100 and you can place one mini lot size. You can place 0.01, which is one micro lot size, or any lot size that you please based on the leverage that you've selected. The next Forex jargon that we have to unveil is what is equity and margin. Firstly, I want to explain margin because it kind of relates to what we said earlier, leverage. Now, remember the amount of money that you put down, which is 113 that you put down earlier, is what we call margin. That's your 1% that you put in is what we call margin. It's very simple. Now, I'm not trying to give you definitions. I'm giving you a practical example of how it works. Now, just look at all of these things. It's super simple. Now, let's say you are trading a contract Euro USD, for example. All right, Euro USD, and you put in 1 mini lot size. And to buy this one, you need 11,322. Now, your broker is going to put down 99%. This is what we call leverage. We treated that earlier. While the amount, the 1% you put down is what we call margin. So this is solved. The next one, I'm going to explain equity with the help of this next example. Now, remember, just to recap, the borrowed fund, which is leverage, is 11,209. your margin is locked down right here, and your account balance is $1,000. Okay, and let's say you come up with a trade. First, let me explain another principle which is going to help us. Free margin. So your equity is margin plus your free margin. So this is your free margin. Now, what is free margin? Amount of money that is left after when you subtract your margin from your actual balance. When you place a trade, your balance still remains $1,000, even though 113 has been deducted. It's not going to show that it's been deducted. It's still going to show $1,000, but at the back end, this is what is happening. It's going to be fluctuating on your MetaTrader 4 at the top right corner. So this is what I'm explaining. So your free margin is an amount of money that is left for you you are left with for you to place more other trades, or the amount of money that is left for your trade to run. Okay, once it is moving up and down, if you're in profit, you're in loss, it will keep deducting and it will keep increasing based on the condition of the trades that you've placed. Now, equity is the summation of margin and free margin. So when you add 887 plus 113, that is your equity. Okay, it's going to give us $1,000. That's because nothing has moved here. No trade has been placed. So when you have not placed any trade, your balance and your equity, everything still remains intact. It's still all the same thing. Now, let's say we have placed a trade. Now, we hop on and trade Euro USD, and we are currently making a loss. Now, I'm just going to give this example and let us make a loss and deplete everything so that you are going to see how it actually works. Now, you have negative $200 on your account. So your free margin is going to read 687. While your margin is static, is the amount of money that you're using to purchase. While you borrowed from is still static, broker is giving you 99%. I believe you understand. So these two of them is equity, while free margin is just amount of money that is left for you to place more trades. So this will keep fluctuating as long as your trades are open, same as equity. All right. So now let's keep on going, and you keep on losing this your trade. Now you're negative $400 on your account. What happened? Your free margin keeps reducing while everything still remains intact. What happened? You keep on losing negative $600, keep on losing. Now, when all of this buffer is over, what happens? Your account is said to be blown. This is what we call account is blown. Now, the only money you're going to be left with is going to be your margin. So they are going to close this account. They are going to pull out this money. All right, broker takes their money immediately. Broker is going to withdraw their 99%. Nothing happens to this money. So this margin returns back to your balance, becomes the balance that you now currently have. Now, there are times where there's a high volume in the Forex market, a high volatility, whereby your margin will be affected a little. Maybe, let's say you'll be able to have $100 left because the move was so high, very volatile, that they were unable to respect your stop order, or it was unable to close out when your money finished. All right, so once this money finishes, the next money you're going to enter is going to be your money. So they actually use this margin as a safety net to protect their own money that they are bringing in. Of course, they want to protect their money. This is a huge amount of money, right? So they wouldn't want to lose it. Next one example, let's say you are profitable. Now, here is an example of profits. Let's say you were profitable on the trade. You took on a trade and you were profitable. Now, you are positive 200. So it's going to be 200 plus what you currently have here. It's going to be 200 plus your free margin. All right. So it keeps increasing. And this dotted line right here is where you set your profit order at, and it hits your profit. Now, what is going to happen is going to hit take profits. When that happens, is the trade is going to be automatically closed. Once the trade is closed, immediately the broker pulls back their 99% again. Your margin returns back to your balance. The margin returns back to your balance, and your money, your take profit, the money that you make, $200 also returns. That is how the trade is gonna be closed for that particular contract. That is how it works on the back end. All right, it is not this slow. Just remember, I'm only explaining so that you know what is happening at the back end. Take profit is an order that you set awaiting the market, that whenever price gets here, it should lock you out and it should hit you out in profit, and you are okay for that particular trade. Okay, let's say for example you hit on a buy Euro USD, you entered at this dotted line, and it keeps going up. Now, buy simply means you are expecting the market to rise. If you sell, you are expecting it to drop. So you said buy. So you keep buying, and once you hit this point, it's going to close your order automatically. Even if your phone is off, your laptop is off, any trading tool that you're using, even if it is off, it's going to close that automatically. So these orders are automatic. This is an example. Now, when this candle hits this line, it's going to close this order immediately and stop it and keep it for you in your balance, and your profit is waiting for you and you're smiling. What is stop loss? Stop loss is super important. This allows you to stay in the business for so long and for you to control your risk. Now, the reason why I think Forex is less risky business is because of stop loss, because you can predetermine your risk even before you trade. Now, how does stop loss work? Stop loss is a pending order that you set awaiting that just in case this market do not go as planned, you should hit me out in this much loss. This is what I'm allowed to take. That is what stop loss is. It's very simple. Now, if you notice this trade, we entered on a buy at this dotted point. It was going on in profit. This blue represented profit. From here, started declining. It went past this our entry point, so it kept on coming down. As at the point it came below this our entry point, then we are already negative. It's red. So we said once it hits this line here, that's our stop loss. So it hit this line. Even when our devices are off, we are away from our laptop, it's gonna hit that line, stop loss. Then your loss is waiting for you on your MetaTrader 4 or your MetaTrader 5 or CTrader, whatever platform you are using. So now the same thing also happened. This is for a sale example. Now we sold at this point, it kept on coming down. Once it's coming down, that's when we make profit for sale. So from here, it started reversing, started going up. So it hits, this is our entry point. So everything became neutral here. Then it went further, kept on going. Then we are red here. So once it hits this line, that's our stop order, and that's it for that trade. Here's a video on how to download